Hi, this is Brian Resney, President of Resney Wealth Management. I'm bringing an important update about a specific investment out there that we keep getting emails, calls on, not only in the office, but with our radio show. It's called an equity index annuity or fixed equity index annuity. These are basically fixed annuities that credit interest based upon how a specific index in the stock market performs, usually the S&P 500. These products are marketed by insurance agents and they're sold to you, the retiree, and in my opinion are probably one of the worst investments in my 27 years of business that I've reviewed and studied. Now I want to talk a little bit about how these products work and why I feel that these products are bad for your financial health. Bottom line is this: any product that claims to have 8% returns, guaranteed income, and basically free money bonuses is going to cost you something in the long run. There are no 8% return investments that are guaranteed. There are no free money bonuses that you're really going to get that don't cost you something in the end. And I'm going to talk a little bit about that. Again, I talked earlier that these products are sold, not bought. They're often sold to senior citizens, 65 and up. And those, unfortunately, are the people that should not be buying these products. There's huge claims that they make 8% guaranteed rates of return. I want to hit that one first. That 8% guaranteed return that some of these products say they make is totally false. That would be on an income rider only. And what that means is there's your money in this product. Let's say you put $100,000 into this product. They tell you you're going to get a guaranteed 8% return. The only way you can get that guaranteed 8% return is on the income rider that usually has an added cost to it. And the only way you can get that income stream is if you annuitize these annuities. Once you annuitize that annuity, they then credit your interest usually at a substandard rate of return to make up the hypothetical 8% crediting on the income rider. So again, there's no free money. So if you think you're going to make 8% on one of these products, you are sadly mistaken. Again, that's an income rider. Income riders in theory could work well if you're extremely young and you're in the accumulation phase of an annuity. Meaning, if you're 30 or 40 and bought a $100,000 annuity, that income rider that would guarantee an 8% compounding rate for the income rider might make sense, okay? But not for somebody 65 or 70 or 80 who's going to be taking money out. You're not in the accumulation phase anymore, so that whole 8% theory throws out the window. Number two, the rates of return you can make on these products are going to be substandard at best. They will credit interest based upon a various index, let's say the S&P, but you don't get that whole rate of return, you get a percentage. There's caps on these, there's spread fee margins on these things, so at the end of the day, most of these products, if the S&P goes up 8% a year, you'll be lucky, in my opinion, if you make 3 to 4% on most of these products. Number two, guaranteed rates of return. They talk about a 3% guaranteed return on some of these products. That 3% guaranteed rate of return isn't really 3%. It's often 3% of 85% of your money. So again, if you put $100,000 in these products, they're going to cut it down to $85,000 and credit the 3% onto that. It would take you 7 years just to get back to your original $100,000 with a 3% guarantee on 85% of your money. Again, horrifically bad. The other problem, number three of the main points that I want to cover, is large back-end surrender penalties to get all your money. Any investment that claims to be so great, so good for you, the retiree, that has a 12, 15, 22-year surrender penalty before you can get all your money is not right. If the investment is so good, why do they have to have that big back-end surrender penalty for many, many years? Reason is they have to pay huge commissions to the selling agent, again, selling you a product, and to basically recoup any free money bonuses that the company has basically given you. Again, number four, free money bonuses aren't free money at all. The only way you ought to get that free money bonuses is, again, if you annuitize that annuity, and then what they do is they pay you substandard rates. So when somebody tells you your $100,000 magically becomes $110,000, you should run, not walk away from that investment product. The bottom line is this: investors, especially retirees, are easily swayed based upon emotion. They're often sold these investments at free lunch seminars that basically promise the world, and this is your savior from stock market declines. Unfortunately, what you don't know, or what's not properly explained by inferior salespeople who really have a lack of knowledge about these products themselves, is hidden fees, hidden agenda, large costs, big back-end surrenders, and at the end of the day, your best interest is not served. If somebody tells you you shouldn't use a fiduciary, they're basically selling you a product for a commission, and all they care about is themselves. If you've bought one of these equity index annuities, I'm sorry to tell you, you probably have yourself one lousy investment. If you're thinking about buying an equity annuity, heed this warning. Do a lot of your own research, ask a lot of questions, and at the end of the day, you're probably much better off to build a very conservative portfolio of fixed income investments that has complete liquidity without the back-end surrenders of equity index annuities and without the long-term surrenders that many of these products hold, and also the inferior rates of return that they are probably going to produce over the next 5, 10, and 15 years. Before you buy one of these products, make sure you do your own research. If you bought one of these products and you're not happy, and you're looking for real investment management from an actual money manager, a fiduciary who works in your best interest and works fee only, not on commission, we don't sell investment products, call our firm. We would love to help you rebuild your portfolio in a manner that's right for you. Also, if you'd like some more research about equity index annuities and some of the warnings, go to my website, resniwealth.com. In the Investor Resource tab, we've got many articles written about equity index annuities and how they work. Let me kind of give you a couple quotes on equity index annuities. These come from Kent Smetters, former economic policy official at the Treasury Department. These contracts have high hidden fees that they're terrible ideas for the older people, even though they're peddled to them. Let's talk from Barbara Roper, Director of Investor Protection from the Consumer Federation of America. These are one of the most abusively sold products in the market today. William Reichstein, Professor of Investments at Baylor University. Index annuities underperform a lower risk strategy of rolling over even CDs because of the high embedded cost involved with these. Insurers sold $8.7 billion of these equity index in the third quarter of 2010 because they're sold is the bottom line. They often have commissions as high as 12-15% with surrender periods as long as I've seen 22 years. So again, the SEC's put warnings out on these. FINRA's put warnings out on equity index annuities. Most state insurance departments have put warnings out on these products that they're highly complex and that investors should worry and run from how often these products. You can take a look at our website, go to the Investor Relation tab or Resource tab, research these for yourself before you're sold a product that promises the world but often fails to deliver. Again, if you bought one of these products and you're not happy and you want to know what you could do, you can always call our office. We'd be more than happy to help you rebuild that portfolio. Until next Sunday's radio show, make sure you have yourself an extremely profitable day.